Also, watch out for the yuan this week. According to Standard Chartered, looks like China could scrap the yuan peg sometime this week. That's right. This is the time period right after the Shanghai Expo opening and right before the U.S. talks. And in fact, it would be a good opportunity to let the currency float, according to the bank. Let's bring in the author of this prediction. We have Stephen Green, head of China research at Standard Chartered, who's making this forecast, and he joins us this morning from our Beijing studios. Stephen, yeah, it looks like it is good timing, but as you know, China is not really concerned with good timing for others, right?
Yeah, well, we looked at this. We made this prediction about a month ago, and at the time, this week looked pretty good to us. As you say, after the Expo opened, before the Strategic Economic Dialogue in a couple of weeks' time, looked like a good, quiet period for them to start, just to move it around a little bit. No one big one-off moves. Having said that, with Europe in the state that it's in, financial markets very, very nervous at the moment. Might not be the right week to begin that big move.
Yeah, exactly. I was going to point that out as well. And also, can't China now point to its trade deficit, back-to-back monthly trade deficits, as a reason not to touch on the currency?
Well, we slightly disagree with your with the consensus on that. We do think there's going to be a small, maybe a $3-4 billion trade surplus in April, but it's obviously very, very small. I think, though, that most economists agree that that is the result of a massive, massive boost to imports with the stimulus. China's stimulus is peaking. It's going to be slowing shortly. And then you'd expect a gradual recovery in exports. So you're going to see the trade surplus reassert itself by the end of the year. But I think that's obviously a good reason not to expect any one-off moves, a 2% move or a 5% move in one day. I think we're going to see very, very small moves around the fixing, gradually increasing over time.
What about this concern over Europe right now? I mean, that is the talk. We have markets opening in just about an hour from here, 45 minutes or so. They're trying to hammer out a rescue, a bailout, sort of a loan facility in the Eurozone at this point to, I guess, give some reprieve to the market, some stability. But how do you think China's going to be affected by all of these concerns of contagion taking place in Europe?
Well, Europe is China's biggest export market, and we have seen a strong recovery in exports to Europe in the last 6 months. It's accounting for about 30% of China's exports. So obviously it's going to be creating some nerves. You'd expect also, the other thing is that as the dollar has strengthened over the last few weeks, the renminbi's real exchange rate has also strengthened. So another reason not to move big against the dollar.
That's right. You did see the yuan and it basically revalued when the euro plummeted last week. So maybe that does give China some more firepower not to move on its currency. But let me just ask you about consumer prices. We also have CPI numbers due out this week as well. Do you think that's a concern right now with people pointing to pretty high inflation in the coming months?
Yeah, it's going to come in at around 2.8% year on year. It's floating around 0.2%, 0.3% month on month, seasonally adjusted at the moment. I don't think it's the biggest concern. What we've seen, though, really over the last 3 to 6 months is across the board withdrawal of China's stimulus. So controls on bank lending, fewer new infrastructure projects starting, a big move on real estate to cool down some bubbles in Shanghai, Beijing and some other cities. So what I think you've seen is that policy stimulus being withdrawn, and we'd expect some of those inflationary pressures by the end of the year just to cool down a bit. Having said that, imported inflation is rising, and if the global economy does continue to recover, say, next year, that will mean oil prices and all the other commodity prices will go up, and that will give China some inflationary problems as well.
Yeah, Stephen, recently we had Mark Faber on Friday, actually more than that, I think a week ago, and he was talking about this clampdown on property prices, possibly leading to a crash in Chinese stocks and also the economy in 9 to 12 months. What do you think of those predictions?
Well, we think that the measures were clearly targeted at around 5 cities, Beijing, Shanghai being the biggest of those. We think also that in 6 months' time, if we did get a serious price correction, maybe 20–30% in those cities, that you could easily see a relaxation of those policies. I think what the government at the moment is trying to do is trying to take some of the heat out of the economy, trying to organise a soft landing, and we're relatively confident they can organise that. We are going to see slower growth for China over the next couple of years, single digits, 6, 7, 8%. But once we've sort of got down to that level and stabilised, I think maybe some confidence will return. Obviously, markets are a little bit nervous because we are now slowing down. You can see the government withdrawing that stimulus, so everyone's just a little bit nervous about how far that will go. But we're not too worried about next year.
All right, Stephen, thanks for joining us that early in Beijing.